Hi, I'm Tom Elliot and welcome to another financial markets update for Hodges Real Estate. Well, there was good news for property buyers at the start of this month. The Reserve Bank, somewhat surprisingly it must be said, decided to cut interest rates again, the official rate of interest at a record low now in Australian history of just 2.75%. What was also good news was that the big banks decided to pass on the rate cut in full. In fact, a couple of them added a couple of basis points to their rate cuts for good measure. It seems that the big banks have finally rediscovered the spirit of competition. Because credit growth has been relatively slow for them, they need to do everything they can to try and get new customers across the line. And if that means offering home buyers a cheaper than expected home loan, well, now is clearly a great time to be borrowing money. What is intriguing, however, is that over in America, where not only have they had interest rates close to 0% for quite some time now, but the Federal Reserve, which is the equivalent of our Reserve Bank, has actually been printing money, a process known as quantitative easing, to try and lift the US economy out of the hole that it's been in for quite some time. The US Federal Reserve might actually soon come to the end of that money printing process. Just a couple of days ago, Ben Bernanke, the chairman of the Federal Reserve, suggested that it had done as much heavy lifting as perhaps was needed. This, I must say, sent the stock market into an absolute tailspin. Our market fell 2% in a day on this news. Cheap interest rates and cheap money around the world have been the driver of the recent rally in the stock market over the last 12 to 18 months. And no one wants to even consider a time when the Americans might stop printing money. So it's rather odd at the moment. The Reserve Bank in Australia clearly sees some weakness ahead in the local economy and is cutting rates. But in America, where rates have been excessively cheap for quite some time, they're contemplating rates eventually beginning to rise fairly soon. So that could happen towards the end of 2013 or early 2014. And one of the things about markets is when they realise something is about to change, the markets change straight away. They don't wait for the Reserve Bank or the Federal Reserve in this case to tell them exactly what's going to happen. May has also been a big month for looking at politics because of course we have the state and federal budgets. Now firstly the federal budget, but Wayne Swan predictably said that revenues had fallen in a hole yet again, that spending unfortunately had to go ahead, and as a result we have yet another federal budget deficit. This time for the current year is predicted to be around $18 to $19 billion. The same amount again will be in deficit next year. My view is we'll probably have at least 4 or 5 years of deficits. Now the bad news about this is that eventually all the debt that's being accumulated will have to be repaid. Government debt, I reckon, will peak. This is gross debt at around $370 billion in 3.5 to 4 years' time. It's not a big number compared to the sorts of debts that overseas countries have, but when we look at those countries and how much economic trouble they're in, there's no need for us to try and copy them. So should the political fortunes go the way that the polls expect and Tony Abbott gets elected Prime Minister in mid-September this year, he and the Treasurer-to-be, Joe Hockey, will have a lot of work to do trying to get the public finances back into shape. They've said they want to get back into surplus, but I must say I do not see easily how that can be done. It'll be a very, very tough process for them. One of the other things that was important about the federal budget was the unemployment forecast. Now at the moment unemployment has stayed resolutely low around Australia and indeed in Melbourne at around about 5.5%. Wayne Swan did admit on budget night that on the Treasury forecast he expects unemployment to rise to 5.75%. Not a big rise, but a rise nonetheless. So again, we might see a bit of slowing in the Australian economy, but the good news is, as I mentioned earlier, the Reserve Bank of Australia, if that happens, will cut rates further. And I reckon rates will be maybe another 25 basis points, maybe another 50 basis points. Again, if you look at the fixed home loan rates on offer, they have hardly shifted recently because the fixed market is predicting the 2 or 3 cuts in the floating market that we're in the middle of probably getting. Now what about the state budget deficit? For property investors, there's probably something more concrete in that the first home buyers grant at the state level was abolished. Now it still exists if you buy a new house up to a value of $600,000. In fact, the state government will now give you $10,000 to assist with the purchase. But as of July 1, which is not very far away of course, if you're buying an existing house there will be no more state government grant. From what I can gather, there's already a bit of a rush on at auctions for properties under $600,000 for people who are first home buyers and want to still get the bonus while it remains for the next month or so. So although there's a bit of strength in the sort of entry-level market, $400,000, $500,000, $600,000 at the moment, post July 1 you might see the number of bidders at auction there, at least first home buyers, drop off and the grant is no longer there. So I guess that's minor but bad news for the property market. Having said that, the property market has been pretty good overall. The clearance rate is 73, 74, in some weeks 75%. As I said, interest rates coming down. Numerous auctioneers report multiple bidding at auctions, especially for sought after properties. It sounds a truism to say that, but it wasn't long ago then so many properties were just being passed in and negotiated afterwards. It now seems at auction people are prepared to bid. Of course, bad news in some areas. We've learnt just recently that Ford has decided to close car production in both Broadmeadows and Geelong. I did a bit of digging around in my economic history books. Now, when BHP shut down the Newcastle Steelworks in 1999, there was a definite softening of the property market for a few years because so many people lost their jobs. The good news is that Newcastle recovered, the people who lived there found other things to do, and the property market recovered as well. I reckon the same thing will happen for Geelong. There might be a bit of softness in 3 years' time and in the lead up to 3 years' time when the Ford workers sadly lose their jobs, but eventually Geelong has got many other vibrant industries and I think has a good future. Broadmeadows might be a different story. Broadmeadows doesn't have too many other big employers like Ford. In fact, there are more Ford employees, I think, at Broadmeadows than there are at Geelong. So those are two spots certainly to look out for. But overall, the property market, look, the clearance rate remains good. Financing is cheap and easily available. To the extent there's any bad news on the economic horizon, I don't believe it will be too bad. For instance, the unemployment rate going up. And as I said, should economic news in Australia get worse, the Reserve Bank will almost certainly cut interest rates again. They'll do what it takes. All right, thanks for your company, and I'll look forward to doing it again next month for Hodges Real Estate.